South Africa's current economic position is marked by subdued growth, structural inertia, and cautious reform optimism. The numbers are stark. The economy has been growing at just 1.3% over the past 15 years or so, barely keeping pace with its expanding population. Unemployment hovers near 33% and GDP per capita has declined, not just in relative terms, but absolutely. While the world has grown richer, South Africans on average have grown poorer. External forces are not helping. Restrictive monetary policy in some key developed markets like the United States has squeezed emerging markets. Geopolitical uncertainty has disrupted oil markets, supply chains and capital flows, while US President Donald Trump's tariffs are threatening global growth and trade. And yet there are glimmers of hope in the country. Electricity supply continues to stabilize. Policy coherence is emerging, albeit unevenly, under the Government of National Unity. And initiatives like Operation Vulindlela have shown that reform, when it comes, is not impossible. Hello, I'm Jeremy Maggs, and welcome to No Ordinary Wednesday, where we explore insights and perspectives on issues that shape economies and global markets. Today we ask the question, what will it take to transform these fragile green shoots into a sustainable economic renaissance? What levers need to be pulled to raise South Africa's growth trajectory to somewhere between 3 and 5%? It is only at that stage that jobs can be created, investor confidence restored, and an inclusive economy can be achieved. In this episode, I'm joined by Investec South Africa Chief Executive Officer Cumesh Moodliar and investment strategist at Wealth and Investment International, Osagyefo Mazwai. And together we're going to examine what's holding South Africa back, what needs fixing first, and what bold ideas could finally unlock the country's immense promise. Cumesh and Osa, a very warm welcome to No Ordinary Wednesday. So, Cumesh, to you first of all, and we are recording this episode just a few hours after President Trump announced tariff hikes to several countries, including a 30% hike on South Africa. Our conversation today is focusing on this country's economic prospects. So I have to ask, how do you see these tariffs affecting our economy?
Hi, Jeremy. I think we're living in a very fast-changing world as far as these tariffs are concerned. So I think the letter that was received last night by the South African government, and I think earlier this morning, in fact, the president issued a statement acknowledging receipt of the letter and confirming that the South African government is preparing its response. The key issue here is the following. The one is we've got to look at our continued trade relationship with the US in a different light, which I think is already happening. I think across different industries and with government work streams, a lot of work is being done. The question, however, is given that we've now been issued with this letter, it clearly shows the engagements to date have not yielded the progress we would have liked. We also do realize you're dealing with quite a mercurial approach, I would say, from the US in dealing with these tariffs, because the way I understand it is the door is still open for further negotiation until the 1st of August. So I think it's about how we now get our so to speak, ducks in a row, to have the conversations around what are the key trade areas that we think we can extract value and benefit for South Africa and create value and benefit for the US. And the US has ultimately adopted a laser-like focus on reducing its trade deficit with all its trading partners. If we take the South African trade, for example, we've got to look at areas like rare earth metals, we've got to look at agriculture, we've got to look at, for example, the motor industry, all of which have been beneficiaries under AGOA, and say, how is it that we can restructure a package that allows us that sort of access to the US market? And what is it in the, for example, the rare earth metals that the US requires from SA? We know ferrochrome ore is one of those metals or commodities that is required. And secondly, looking at, for example, our ability to require or the supply of gas from the US for our energy needs. So I'm sure there's a deal to be done. And I think we've got to continue working on it. I don't think what we've currently seen is necessarily cast in stone until all of this work has been done and the next level of negotiations takes place.
Also, let me bring you into the conversation, and I want to take a step back to unpack where we are and where we're headed. Now, Investec posits that had South Africa grown at 4.5% annually for the past 15 years, we could have reached nearly 12 trillion rand in GDP today. So how do you interpret the opportunity cost of this lost decade of growth?
Thanks very much, Jeremy. And I'd like to split this question up into two distinct answers. And the first one will deal specifically with opportunity cost, but then I'd also like to then delve into the questions around what's happened with our nominal GDP trajectory and the kind of effort that needs to be made in terms of clawing back those losses. So as we said, had South Africa grown in line with emerging market peers at 4.5% over that period, then the size of the economy would be around 12 trillion rand. Right now, it's sitting at 7.4 trillion. And that gives you a sense of the sheer magnitude of the lost economic activity in South Africa. And then when you go into further detail and you look at the fiscal repercussions, then over that time period, on a cumulative sense, the fiscal has lost around 5 trillion rand. You look at our gross national debt, that amount would have wiped out the vast majority of it. And just looking at a 5 trillion rand in isolation, then you look at things like Eskom. Eskom's debt is 400 billion. You take that out quite easily. Transnet's debt is sitting at around 200 billion. You take that out quite easily. So it just tells you that the opportunity cost has been significant as far as the delivery of services is concerned. A hell of a lot could have been achieved with that 5 trillion in terms of delivering services to the people, in terms of building roads, building infrastructure, and creating a fundamentally different economic environment. The second point I'd like to make is around GDP per capita. And we can see in 2010, there was a stark dislocation between our nominal GDP per capita relative to the rest of the world. In fact, at this point, South Africans are around 40% poorer than the rest of the world on average. And then you take a look at that and you ask yourself the question around, has economic policy then really been transformative when you look at the average South African? Because if South Africans are now 40% poorer than the rest of the world, then something has to be done. We've done the work for South Africa to get back to the average nominal GDP per capita over 10 years. Nominal GDP per capita has to grow at 8% per annum on average. That just tells you how exceptional our GDP growth has to be going forward. And to be exceptional in that time period, you only get back to average. So there's no time to waste. The government has to move with a little bit more haste and be fundamentally committed to the GDP growth story, because through that, you will have meaningful transformation of people's lives.
Cumesh, back to you. And within the context of the opportunity cost of this lost decade of growth, what happens next then to ensure that it doesn't happen again? And how do you operationalize that in an economy with limited fiscal room, high inequality, and low trust in government institutions? So, very simply, what should the number one priority be for government?
I think, Jeremy, it starts with the basics. It's around execution of service delivery. I think once we get basic service delivery in place, you immediately change investment sentiment. Investment sentiment boosts investment confidence and unlocks capital to invest in South Africa, be it private capital. And when I say private capital, both local and international capital can be unlocked to support South Africa's growth. I think what's highlighted from Osa's comments has really been, when we talk about these concepts of inclusive economic growth, GDP growth, etc., often to many people it sounds like a more abstract discussion. But what Osa's illustrated has really been the fact that if the economy fires on all its cylinders, if it was a motor vehicle, then what you're really starting to do is you're creating the operational budgets and cash flow and surpluses through collection by the fiscus of these funds, which can be deployed to help support a growing social welfare net where appropriate. But as important, and in many cases, in terms of the longer-term investment of the country, investment in infrastructure, which will support growth, which will support a growing population. And it's that growth in what the fiscus can collect off a growing economy that helps grow the country as a whole. And there also has illustrated it very clearly around the current debt level, say, for example, of the SOEs, where the economy starts to power up. That debt can easily be retired over a period of time and create capital for further investment.
So, Osa, Cumesh says it's about service delivery to unlock confidence. We know business confidence remains subdued in the country. You contend that boosting confidence is one of the most powerful levers for growth. Why is that?
Well, there's significant historical precedent when we make the argument around business confidence. And I'd like to take us back to the period between 2004 and 2008 specifically, because that was a period where you had elevated business confidence and you had very robust economic growth of above 4% consistently over that time period. But then you also saw the unemployment rate decline from around 28% in 2004 to 21% in 2008. So that historical precedent tells us that business confidence is one of the fundamental pillars or levers that you can pull in terms of then getting better economic growth outcomes. But then in turn, because you're getting better growth outcomes, then that provides a basis for better employment outcomes as well.
Cumesh, you touched on SOEs earlier. State-owned enterprises, we know, are part of the bigger structural reform strategy for South Africa's economic growth ambitions. That includes, obviously, attracting investment. So what specific reforms do you think will signal that the country is open for business?
When we look at that, I think the key infrastructure sectors we've seen over the last 3 to 4 years, the reform that has taken place, and it's been longer than 3 to 4 years, but we've really seen the positive impact of it in the last 3 to 4 years around the ability to create renewable energy and generation capacity outside of, for example, Eskom. And we've seen also key reforms undertaken by the newer leadership team that's probably not that new now. It's been about 2 to 3 years that this team has been in place in Eskom. We've seen how those efforts have really helped the turnaround. The debate for us is now, if I look at what are the key SOE reforms we're needing in the current environment, fully understanding that the work that's continuing at Eskom and in energy supply has to continue and continue to be accelerated. Secondly, the infrastructure relating to logistics and transport is key. We getting our mining product out, getting manufacturing product out to ports, being able to rail those products within the country itself, not just to the ports, is critical. We saw that over the last period of time, and we saw off the back of the commodity boom what a difference it made to the fiscus and the revenue overruns that were created as a result of that. We've also seen at a time when there was a second commodity boom that the fact that infrastructure was not sufficiently in place to support it, that at times many of our mining companies were not able to get their products to the port. We've seen that happen a few times. I think key reforms in SOEs have to be around rail, ports and roads, and how we build that out going into the future.
So also, speaking of the commodity boom, underperformance of SOEs coupled with logistics bottlenecks in an environment that has seen commodity prices elevated is preventing South Africa from capitalizing fully and boosting our balance sheet. So then, in addition to what Cumesh has said on the commodity boom, have we missed the golden opportunity, do you think, for precious metals?
Well, I think Cumesh has already gone somewhere in answering this question. He's alluded to the fact that South Africa is a commodity exporting nation, and we've benefited from elevated commodity prices before, the most recent being around 2021, 2022, where the fiscus collected an additional 200 billion rand due to the commodity boom. But the critical thing, as Cumesh has said, is around the logistics and energy sectors. You need power for mining to happen, for an example, but you also need the transport networks to work so that you get that volume advantage. You've got a price advantage at this point in time, but we are missing out on the volume aspect. And then, of course, then that volume aspect is where the opportunity cost really lies. So from a sequencing of policy, at the center of the reform agenda is capacitating these network industries, energy and logistics, so that we can benefit from environments such as these where you can mine the stuff, but you can also get it to market.
Cumesh, as we think about our economy, we cannot discount global pressures. We're seeing slowing global growth, tighter monetary conditions in advanced economies, and rising geopolitical tension. So, in your opinion then, how vulnerable is our country to these pressures, and could they complicate our domestic growth strategy?
I think we're living in a world where this fast-pacing change in the global environment, which we chatted about at the outset, Jeremy, is something that we've clearly seen the country is not immune to. If we look at our GDP forecasts as we entered 2025, generally consensus view was probably between 1.8 to 2% of GDP growth. And as global volatility combined with some concerns around SA macros, but as global volatility came into play, we've seen most institutions in South Africa revise their GDP growth targets downwards. In fact, as Investec, we recently revised ours down to 0.9% from 1.8 at the outset of the year. That is significant. So it shows you there already has been an impact, and that's impacted on our current forecasting, and that obviously flows through into the coming year as well. So the debate for me is really to say that we've got to realize this is a really serious issue for us as a country, and time is not on our side when we look at these opportunities. So we've got to say, how can we look at focusing on getting the basics right with a high level of speed of execution? But the ideas of potentially sitting back and thinking that we're going to be an exception to the rule. In one of our earlier discussions, I think I'd said that SA exceptionalism is over and we have to accept that. And that we have to focus on what are the key basics we can do right. And I think as a country, we are richly endowed in so many ways. We have incredible people, we have incredible resources, and we have great institutions in many respects, both in the public sector and in the private sector. And I think it's how do we build on all of those things to build out a future that's probably going to be in a world of greater levels of bilateralism than multilateralism, and how we look at building out our relationships with key trading partners that we have really good relationships with. So if I look at countries, and I'd still include the US, that's how we rebuild that. I look at Europe, our key strategic trading partners in Europe and the United Kingdom. I'd look at China. I'd look at the Middle East, where we have very strong relationships across the UAE, Qatar, Saudi Arabia, etc. How do we continue to build on other relationships and see the world differently and realize that we have a lot to offer, from our rich mineral resources to a strong agricultural backbone to good manufacturing capability? And how do we use that to our benefit? So I think the idea of what's been pulled together now, for example, is a national dialogue. In that national dialogue, the economy has got to be a centerpiece discussion.
We're going to continue this conversation in just a moment with a look at what the country's priority on the road to economic growth should be. But first, here's a message from Investec.
They say time is money. Capitalize on your commute with the latest podcasts from Investec Focus Radio. With expert economic and investment insights you can't get anywhere else. We can't promise you'll get there any faster, but we guarantee you'll arrive smarter. Follow wherever you get your podcasts. Investec Bank Limited is a licensed FSP. T's and C's apply.
Also, let's continue our conversation. Fixing the country is going to need different stakeholders working together towards a common goal. And obviously that starts at the top. Do you believe the current composition of the Government of National Unity can accelerate reforms quickly enough to match the urgency of economic growth? Or do you foresee more policy drift before we start to gain momentum?
In terms of the kind of critical juncture we found ourselves in last year, and what the Government of National Unity represented, amongst other things, was a broad commitment to the continuation of structural reform in South Africa, which was understood to be a fundamental pillar of boosting inclusive economic growth. Now, I think the message is that there needs to be a sustaining of the momentum. In fact, we need to increase the momentum. We need to move with a little bit more haste because time is running out. If we make an example and we say if South Africa's GDP per capita nominal grows at 8%, it will take 10 years to get back to the global average. It tells you that there's no room for error now from the kind of momentum that we need and the policy execution that is needed in order to achieve those kind of growth levels, because that talks to real GDP growth of between 3 and 5%. And that must be achieved consistently over a 10-year period. It's a very tall ask. And it just says that the government of national unity needs to move with a lot more haste in terms of executing policy that is supportive of a broader economic recovery.
Well, I think one was hoping for a far greater speed to the structural reforms, and one understands you have to do it within a policy and a framework of ensuring that you have open and transparent processes. But realizing how quickly the world has shifted even since the formation of the GNU, the idea that we have more time, I think, is unfortunately not true. Time is against us, and we've got to look at probably 3 to 5 key initiatives that the entire GNU can come together and agree on, that we'd focus as the very basics of what we want to do. And I think that would be critical. What is complicating some of the debate around the GNU is you've got local government elections coming up in 2026, and in 2027, the ANC goes to vote for its new leadership. My concern is that that becomes a distraction at a time when execution and delivery and structural reform has to be at the center of what we're looking at.
Cumesh, in a low-growth global environment then, countries have to fight even harder for capital, trade and competitiveness. How does South Africa avoid getting left behind?
I think South Africa is incredibly well positioned in many respects. If I bring it back to the hosting of the G20 this year, the fact that we're able to have the work streams between G20 and the B20 streams that are coming into effect, I think that we have a commanding position in a number of forums globally. And in many ways, South Africa can and has punched above its weight as a country. So the opportunities and the platforms we have are there. It's how we take up that role. And I say this sensitively, but how do we put the needs of South Africa and the continent first? That certainly, when we're looking at our geopolitical positioning, is we owe a significant responsibility to those that remain unrepresented in a large, broad stream economy. And how do we play a role to help people be active participants in economic growth?
And also, with global interest rates expected to remain higher for longer, capital is more selective. In that context, then, is South Africa an attractive investment destination, or do you think we're becoming increasingly peripheral when it comes to global capital flow?
I'd like to refer to something that Cumesh mentioned earlier, and I did note it down, as far as South Africa being an attractive investment destination. And he said South Africa has incredible people, incredible resources and incredible institutions. So that already tells you that South Africa is attractive for many reasons. And South Africa does have deep capital markets. But it's the own goals that we keep scoring that makes us less attractive for global investment. We keep referring to energy and logistics, and those are the bare minimum requirement to have ticked a box in terms of, are you an attractive investment destination? Then you look at the quality of the education, which then says the quality of the people that are employable and in the labor force. Are we showing that we are a capable nation from that perspective? So there are these own goals that we need to answer for, but there is many reasons why South Africa can improve. And as long as you do get that sustained increase in terms of structural reform and capacitating energy and logistics, and then you add another layer and say the people of South Africa are capable. So we just have to get the basics right. It's as simple as one can put it.
So, Cumesh, as we wrap up our conversation, I want to give the last word to you. And conversely, if we get it right and we unlock 3.5% to 4.5% growth sustainably, what do you think South Africa could look like in 2035?
Thanks, Jeremy. I think what we'd look at, if we're able to get to those levels, what you would see is a much lower unemployment rate, and we can put more color to that in time, but certainly a much more lower employment rate, better infrastructure, better quality of life, and I think a narrative for the future which gives the next generation a completely different sense of hope. So to our mind, it would be a more inclusive economy than today's is, with a sense of different purpose and direction as we look into the next millennia.
Cumesh Moodliar and Osagyefo Mazwai, thank you both for joining me on this episode of No Ordinary Wednesday. And as always, if you enjoyed this episode, please follow Investec Focus Radio SA wherever you get your podcasts. We'll be back in a fortnight with more analysis on the major economic trends shaping our markets. Until then, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.